Welcome to TalkTickers. Today we're diving straight into the Rapid7 first quarter 2025 earnings call. Our mission, as always, is to cut through the noise and give you the key insights.
Right. And Rapid7's Q1 was definitely a bit of a mixed bag. Their annual recurring revenue, ARR, the predictable subscription money, landed at $837 million.
Okay.
Now, that's up 4% from last year, which sounds okay, but it was actually a little short of what they were aiming for.
A slight miss there then.
Yeah.
But how about actual revenue?
Yeah. See, on the flip side, their total revenue for the quarter came in at $210 million. That was above their guidance, up 3% year over year. And product revenue specifically, that grew 4% to $204 million.
Okay, so revenue beat, AR slightly missed. What about profit?
Profit looked pretty good too. Operating income was $32 million, also beating their guidance. And they generated $25 million in free cash flow. Solid numbers there.
So far, so good on the actual quarter's profit and revenue. But what about looking forward? You mentioned ARR missed.
Exactly, and that ties into their updated guidance for the full year. They've adjusted the ARR forecast down a bit. The new range is $850 million to $880 million. That represents growth of about 1% to 5%, so slower than perhaps initially hoped.
Right, a noticeable adjustment downward. And full year revenue.
That's also been tweaked, now expected between $853 million and $863 million, which is growth of 1% to 2%.
Okay, so lower top line expectations for the year. But what about the bottom line guidance? Did that change too?
Interestingly, no. They kept their full-year operating income guidance the same at $125 million to $135 million, and the free cash flow guidance also remains unchanged, same range.
Okay, so revenue and ARR growth slowing, but they expect to maintain profitability. That's the key tension here, isn't it? What's driving this?
It really seems to be a tale of two different parts of the business. Their detection and response segment, DNR, that's actually doing quite well. It's their main growth engine right now, makes up over half their total ARR, and it grew in the mid-teens.
Mid-teens growth, that's strong.
Yeah, and within that, their managed detection and response, MDR, basically their outsourced security monitoring service, is huge. Over 75% of that DNR business. They did mention a few large seven-figure DNR deals slipped from Q1 into Q2, but the good news is they said those have now closed.
Ah, okay, so maybe a timing issue partly on that front. And they're expanding DNR too.
Correct. They're working on sort of more customizable options for bigger enterprise clients, more complex use cases.
Got it. So DNR, the find, fix, the immediate problems part, is healthy. What about the other side, the risk and exposure management piece, finding potential weaknesses?
Yeah, that's where they're seeing the challenges. That segment slowed down, missed expectations. What's happening is the decline in their, let's call it traditional vulnerability management business, is dragging things down. It's offsetting the traction they're getting with the newer Exposure Command platform.
Exposure Command being the integrated platform they want people on.
Exactly. The whole strategy hinges on moving those traditional VM customers onto Exposure Command. But the speed of that upgrade cycle, well, that's the big unknown right now. It's really the key variable for their near-term performance.
Right. If people aren't upgrading quickly, that newer platform growth stalls out. Are bigger economic factors playing into this reluctance to upgrade?
Oh, definitely. They were pretty clear about that. Customers are just being more cautious. Deal cycles are stretching out longer. This seems particularly true for mid-market companies in North America. Budgets are getting scrutinized much more heavily.
And that hits the risk products harder than the detection products.
It seems so. The risk and exposure stuff, which is maybe seen as more proactive long-term, that seems easier to delay when budgets tighten compared to the immediate need for threat detection and response.
Sort of deal with the fire right in front of you, that mentality prevailing over fire prevention.
That's a pretty good analogy, yeah. It seems that way. But on the positive side, they are making progress on costs. They talked about investments to improve their cost structure.
Like the India Operations Center.
Exactly. Leveraging that new center, streamlining processes. They're aiming to get profitability reaccelerating in 2026. So they're focused on efficiency too.
Okay, so pulling it together. The slower start, particularly in risk management, plus that increased market caution, that explains the lowered full-year ARR guidance.
Precisely. It reflects the reality they're seeing. But again, maintaining the operating profit guidance shows discipline on the cost side, which is important.
And strategically, they're sticking to their guns.
Seems so. The focus remains on product innovation, both DNR and risk exposure customer success, and driving profitable growth with strong cash flow. They also mentioned bringing on some new board members with relevant experience.
Let's dig just a bit more into the Q1 numbers. Anything else stand out in the detail?
Yeah, a couple things. The ARR growth they did get was split pretty evenly between new customers and selling more to existing ones. ARR per customer ticked up slightly, about 2%, to around $72,000. And the total customer count also grew 2%, just shy of 11,700 customers.
Okay. Slow but steady growth in customer metrics. Any geographical differences?
Actually, yes. International seems to be a brighter spot. International revenue grew 10% year over year. It now makes up a full quarter, 25% of their total revenue.
Interesting. 10% growth internationally versus much lower overall growth.
Right. And margins held up well. Product gross margin was 76%, total gross margin 75%. Pretty healthy.
And the outlook just for Q2?
For Q2, they're expecting revenue between $211 and $213 million. That's 1% to 2% growth year over year. And non-GAAP operating income between $30 and $32 million.
Okay. Let's circle back to that exposure command upgrade cycle. It sounds absolutely critical. Why are customers hesitating beyond just budgets?
Well, they understand the benefits. Managing risk in complex cloud and SaaS environments is tough. Exposure Command is designed for that. But yeah, it largely comes back to budget, especially in that mid-market segment. Rapid7 knows this, and they mentioned they're actively looking at refining the packaging and pricing to make that upgrade easier, more palatable.
Makes sense. And the competition in just the traditional vulnerability management space. It's crowded, isn't it?
Oh, absolutely. Highly competitive. Rapid7's angle is pushing Exposure Command as more than just VM. It's integrated risk visibility across the whole attack surface. They want to differentiate from point solutions. So successfully executing that upgrade cycle isn't just about revenue, it's about making their platform stickier and moving customers away from standalone VM competitors.
And having a strong DNR business probably helps that conversation, offering consolidation.
Definitely. If a customer already uses their DNR or MDR, adding Exposure Command for risk management becomes a potential consolidation play, which is attractive to some buyers.
It's interesting, though, how well DNR seems to be doing almost despite the VM challenges.
Yep.
Is that growth coming mainly from existing customers cross-selling?
Actually, no. They said nearly half the DNR growth came from brand new customers.
Oh, wow.
Yeah, so that really suggests DNR has its own strong momentum, its own value proposition resonating in the market, separate from the VM upgrade story. And they expect AI investments to boost that DNR growth and efficiency even more.
We keep mentioning the U.S. mid-market caution. Did they give any more color on why those specific companies are so hesitant?
It seems like general economic uncertainty hits that segment faster and maybe harder. They mentioned different worries depending on the industry, like manufacturing, dealing with tariff concerns, healthcare facing margin pressures, retail looking at cost structures, standard economic anxieties.
Understood. But despite all this caution, what's the general vibe they're getting from customers? Is it doom and gloom?
Not quite doom and gloom. They mentioned signs of stabilization. Remember those deals that slipped from Q1, they closed in Q2. So things are still moving, albeit slowly. The feeling seems to be caution, yes, uncertainty, yes, but maybe not, like the absolute worst of the worst scenario.
Okay, a bit of cautious optimism maybe. And one last area, cloud security. Is that a big push for new business for them?
Their main strategy there seems to be leveraging their existing base. They're focusing on upgrading current customers to their integrated offerings that include cloud security, rather than chasing brand new cloud-only deals aggressively. It's seen as a more efficient way to grow that part of the business, sell more to the customers you already have a relationship with.
And the India Center helps with that broader growth, especially internationally.
Yeah, that's part of it. Better support for AMIA and APAC with multi-time zone coverage, which customers were asking for, plus potential cost benefits and housing development and security operations there. They specifically mentioned AI being key to scaling the MDR part efficiently across those regions.
All right, fascinating breakdown. Let's shift gears now into our This Is Not Financial Advice segment. Based on everything we've just unpacked, what's an outrageous but plausible treat idea?
Okay, so playing on that divergence we talked about. Strong DNR, weaker risk management, particularly the VM upgrade cycle in the U.S. mid-market. Here's a thought. Consider a paired trade. You could go long on a pure play, high growth managed detection and response company, one really focused just on that thriving MDR space.
Okay, long MDR.
And simultaneously, you could potentially short a cybersecurity firm that's heavily reliant on those traditional vulnerability management license renewals, especially if they have big exposure to that cautious U.S. mid-market.
Playing the gap.
Exactly. You're betting on the continued strength of MDR and the ongoing, or maybe even worsening, headwinds for traditional VM renewals in certain segments.
What's the big risk there? What could go wrong?
Well, a couple of things. One, the macro environment suddenly improves significantly, lifting all boats, including the traditional VM players. Or two, Rapid7 figures out the packaging and pricing, and that exposure command upgrade cycle accelerates way faster than we expect, proving the doubters wrong.
Makes sense. Anything else jump out?
Maybe playing the geographical angle. We saw international growing faster, right? 10% versus low single digits overall. And they're investing in that India center to support AMIA and APAC.
Right.
So another idea, maybe slightly less conventional. Go long a basket of cybersecurity ETFs that have a strong weighting towards companies with significant international exposure, particularly in emerging markets.
Okay, betting on international growth.
And you could hedge that by shorting a cybersecurity ETF that's very heavily focused only on the U.S. market. You're trying to capture that potentially higher growth rate internationally while buffering against purely U.S.-centric economic risks.
And the risk for that one?
Geopolitics, obviously. Yeah. International markets can be volatile. Unfavorable currency swings could also hurt returns, even if the underlying businesses do well in local currency terms.
Got it. Two very interesting, certainly thought-provoking ideas there. So that wraps up our deep dive into Rapid7's first quarter 2025 earnings. We've seen the numbers, unpack the dynamics between their key business segments, that strong DNR performance versus the risk and exposure challenges, and looked at their outlook. Now remember, everything we've discussed here is purely for informational purposes. It is absolutely not financial advice, but it does leave us with questions. What are your thoughts on Rapid7's path forward? Do you see this divergence between DNR and risk management as maybe a temporary issue and a potential opportunity, or is it a sign of deeper concerns? We'd love to hear what you think. Join the conversation.